wind down the tactics and the technical aspects of this DVD and start to focus on the economics of the stock market section, we have one sort of final tip, and basically it's a way that you can sort of tune out emotions in a way. When you want to buy shares, the best way of doing it, and what we do, is we always put an order in. Say we want to buy shares at £1, 2 pence per share, so 102 pence. We put in an order for 102. If the market comes down to 102, they will automatically buy our shares for us. We don't need to intervene at all. If you start watching ticker screens and you want to basically manually buy the shares at 102, what can happen is your mind can play tricks on you with the gyration and the volatility. Because the market might come from 106 down to 103, go back up to 104.5 and back down a little bit and go up even more, and then you start to think, oh, I might not get 102, I need to jump in, and it can make you want to chase the market. Whereas just by putting an order in at 102, this is where I want to buy, no nonsense, whatever happens above it doesn't matter, as long as it hits my order, I'm going to buy the shares at the price I want to buy them shares at. It takes all of the emotional side away. You can also do this with limit orders, which means once you've bought the shares, you can put a limit order on, which means when it goes up to £1.10 perhaps, it'll automatically sell the shares. Because if you buy at 102, the market goes up to 108 and then comes back down to 106, you might think, or perhaps it won't get to 110, and you start selling as the price comes down, only to see it go back up to about 110 where you wanted to sell anyway. It's the human emotion side. You want to do everything you can to get rid of that aspect. And by putting in automated orders, you can do that.